Hello, I'd love to hear where everyone's from. Hello.
Looks like everybody's muted right now, Monica. If you want, you can unmute them, or do you want them using chat?
Yeah, if you want to use, everyone could just in the chat box, let me know where you're from. That'd be fantastic. Oh, we've got Ali from Calgary. Perfect. Okay. And it looks like it's working. Okay, perfect. Okay. All right, so we'll just wait another minute or so to let guests get some people in here, and then we'll get started. All right, we got Honolulu. Oh my goodness, Kim from Honolulu. We got Debbie from Calgary, Kirk from Edmonton. Wow, we got people from all over the place. This is awesome. I tell you, this is going to be amazing. Everyone's going to love this weekend. You're going to get so much out of it, so many golden nuggets. Perfect. And if you're coming in right now, I'm just saying hello to you, and I'd love to know where you're from. If you want to type it in the chat box, the chat box is going to be there all weekend. You can ask your questions, make any comments. Please use the chat box as much as possible, and so we can make this quite interactive. It'd be really great. All right. Okay. All right, so what I'm going to do is, okay, so I'm just going to introduce myself. My name is Monica Guerrera. I'm president of the Guru Intelligence Network, and I am here this weekend to be helping out investors really know how to navigate this new financial environment that we're finding ourselves in due to coronavirus. And it's actually some really interesting things happening in the markets these days that we as investors really need to pay attention to. And sorry, I'm just going in here. So this weekend is going to be jam-packed full of golden nuggets, and you won't want to miss a single minute of it. So sit back, grab some paper and a pen, because you are going to want to take notes. We're going to start off with this weekend with some economic info today, so that you know where the market's at and where you need to focus. And I'd really love to hear what your challenges are, what your struggles are right now, what you're worried about, what you want to learn from this weekend, so that we can cover a lot of it, or as much as possible. So please enter any of your concerns and questions that you have in the chat box, and we will cover as many as possible. I want to start by saying that this live stream is for you. If you are a real estate investor who wants to protect and grow your portfolio, you are a strategic investor that strives to be rational in your investment decisions, you're in the right place if you want to know where to focus your energy and money right now. You are an investor who's looking to perhaps pivot your strategy to best suit this new environment that we're in, so that you can reduce your risk and increase your income. If this is you, then you are in the right place, so welcome. If this is not you, if you're looking for a quick way to make a lot of money, or you have difficulty to looking past the headlines, then this may not be the right place for you. If you're the type of person who likes to have other people handle your investments, or you like to follow the crowd and what they're doing, this may not be for you as well. You will want to be here the entire event. If you are unable to stay the entire time, the recordings will be available for sale after the event. And if you do attend the entire event, you will want to purchase the recordings for your video library, because you will want to reference them over and over again. To top that off, there are some amazing free gifts and offers that you will want to take advantage of. Today we'll be focusing on the state of economy, of the economy and where we are in the real estate cycle. We will be discussing what the economic factors investors need to be watching right now are, and what strategies you need to be focusing on. Tomorrow, we will be diving into some specific strategies that work in the current and upcoming real estate market, and some creative strategies to diversify your portfolio. And to start things off today, we have Keith Uthe, mortgage broker extraordinaire. He is a longtime real estate investor and a real estate investment advisor. He is also has won tons of awards for his real estate investing and mortgage broking. He has won the Mortgage Alliance Masters Club 2017 and 2018, the Enrich Mortgage Group Rookie of the Year in 2017. He's also won the REIN Real Estate Professional of the Year 2017 and REIN Innovative Investor of the Year. So please join me in welcoming Keith Uthe. And I'm just gonna make him host here. Just hold up. There we go.
Excellent.
Perfect. It's all yours.
Excellent. Thank you, Monica. Thank you, Monica. Good morning, everyone, from what is a sunny but a little bit windy Calgary. I hope everyone is looking forward. I've been watching Ali. He's making that coffee look really good, the way he's cradling it there and enjoying his little sips. So he's making it look really tasty. So it's great. Glad to have you guys here. Thank you, Monica, for the kind introduction. I'm just going to share my screen here, and we can get into this. Please use the chat while I'm speaking for any questions that come up with regards to things, and we'll certainly have a question and answer time at the end of my presentation for us to go through. So we will have that available to you as well. So there we go. All right. Let's see. Stop sharing.
Sorry, Keith. I've kind of lost control over the participants there, so I don't know if you need to let some people in. So I'll mute myself for the while you.
That's okay.
Okay.
I'm going to, while I'm in there, just 1 second. Oh, I can't make you co-host. I was going to see if I could make you co-host. So
yeah, I couldn't find a co-host button. Sorry, guys.
Yeah, that's okay.
We're still figuring out how to do the hosting thing in Zoom. Sorry, guys.
That's okay. All right. Are you seeing a full screen there, Monica?
I'm seeing the entire screen with your slides on the side.
Okay, perfect. With my slides on the side. Okay, that's
right on the sides.
There we go.
There we go. Okay, perfect.
All right.
All
so
right.
Today, there we go. All right. So today I wanted to cover a little bit about the economics of the current financing landscape, and some of the things that are going around with that can be causing frustration and confusion. So as Monica so generously already said, so I do work as a mortgage broker with Mortgage Alliance Enrich Mortgage Group. The franchise I work with last year was the #1 franchise in Mortgage Alliance in Canada for top units and top revenue. 2018, we were selected as the winners of the Prairie Brokerage of the Year. And myself, I've been honored with being part of the Masters Club in Mortgage Alliance for 2017, 2018, and 2019. I did win the Real Estate Professional of the Year award with REIN for 2017 and 2019, and I am a legal secondary suite specialist. I know the Calgary secondary suite process pretty much inside and out. I've been a part of actually the development of that over the past 8 years, so with direct consultation with the city of Calgary. And a lot of those principles apply in other cities, so it really helps when I'm having conversations with investors from across the country. I do offer a specialized service because I am a Smith Maneuver certified professional. If you don't know about the Smith maneuver, the Smith maneuver is the process by where you can change non-tax deductible mortgage interest into tax deductible mortgage interest using a process that is known as the Smith maneuver. We can certainly talk more about that. And if you have more questions about that later, we can certainly do that. So if you have any questions, please let me know, and we'll answer those further on as well. So looking at real estate and mortgage news. So one of the things that certainly is going on right now with real estate and mortgage news is your mind might feel a little bit like this. You hear something good and you hear stuff that's bad, and it just seems to go round and round, and this is what your brain can feel like. I know some days this is how I feel. So it's not unexpected with everything that we're hearing right now. And remembering that depending on who the information is coming from, there may be some ulterior motive to the information that they're providing. So if you've been watching the news in the last few months, some of the things that they've said, so CMHC said that they forecast a decline in the average house price of 9 to 18% over the next 12 months. So that's one of the things they were saying. They expected home sales to decline 13 to 27% in 2020 in Calgary. Vancouver, the decrease as well. Edmonton, for resale activity to decline in 2020 due to pandemic restrictions and oil price shock. Toronto, not to start seeing recovery through till 2022. So there's many of these things that certainly have been out there to cause consternation for investors. But then we turn around and now we're seeing this. So now we're seeing headlines like in July, home sales hit the highest level in history. So Vancouver, Calgary, Winnipeg post double-digit increases. So that's phenomenal. And it's a rebound due to record low mortgage rates and pent-up demand. Certainly there was pent-up demand because people stopped buying houses in March and April and even part of May. As well, in July, home sales in Canada hit the highest level in history with a 26% increase from a year earlier. So that's an amazing, these are some fantastic things that are happening across the country, not just in the big cities. In July, the most transactions that happened in the last 40 years of Canadian Real Estate Association data. That's an amazing thing to have happening coming, while we're still in the pandemic. Can't even say we're on the other side of it. We're also seeing stats from Canadian Real Estate Association, such as sales rising in Toronto by 49.5%, Calgary sales rising 15.7%, Vancouver 43.9%, Edmonton more modest but still 9.7%, Montreal 39%, and Ottawa 28%. So these are some great things about real estate. But then there's an additional headline that's really also important in this, and that is that Bloomberg reported that there's actually a sharp decline in the use of credit cards at the end of March, which was where the pandemic had already started, and it's been the first drop in consumer debt balances in more than a decade. So if you look at these things, this is a great thing to show that, Canadians are being more responsible than we've been led to believe in a lot of cases. So if we look at the price of oil has been all over the place and just been helping to help recover and bring back our market a little bit. So when we look at the price of oil, we've got the blue line is the WTI, which is the West Texas Intermediate, and the red line is the Western Canadian Select, and the more orange yellow line is the differential in the price between them. So the price differential over the past 2 years, past year and a half, has certainly narrowed, with the price differential being well under $10 now most currently. So the price of oil, if we look back on the chart, with the price of Western Canadian Select at around just over $30 a barrel, puts us in line with where we were in December and March of 2017, 2018. So just be aware that that is something that we need to be cognizant of. So there is a interesting thing for us to be take into consideration, because there has been a lot of media around the fact that Alberta's economy is going to crash because of oil prices. So we're seeing that recovery. We're seeing prices start to come back to stability. So this is going to hopefully be a continued thing. So we'll see more in our market. And with elections happening in the US soon, who knows what's going to happen there and where that's going to have an impact. And then also we're looking at the possibility of having a further Canadian election come when Parliament returns end of September. There's a pretty good chance that we're going to get a vote of non-confidence, and we're going to end up in another election here too. And we'll see what comes from that. We look at the bond yield. The bond yield is an important stat to look at, simply because the bond yield is what bases on fixed rate mortgages. So with the bond yield, you can see that since September of 2019 and a peak in December, January of 2020, the bond yield has lost like nearly 1.5%. This has obviously been reflected in mortgage rates. This is such an important thing for investors and for people that own their own home to keep an eye on, because this dictates where 5-year fixed rates are going. And so if you are following the bond, if you follow the bond yield, if you're having the question in your mind, what should I do with my mortgage? What consideration? One, I keep myself up to date with this and what's going on because my clients are asking me this. But if you want to track it yourself, you can certainly do that. There's plenty of online websites for that, and you can take that and continue with it through your cycle of your mortgage, so that when you're coming up to renewal or trying to decide, should I renew early or should I refinance, those are things that are a factor to consider. So this is one of those things that I want to make sure that you're aware of, was fixed rates or bond yield. Now, as far as variable rates go, variable rates are based off the Bank of Canada prime lending rate, and that's a whole different scenario for what's impact. That's strictly impacted by whether the Bank of Canada increases or decreases the prime lending rate. Bond yields, those are the ones that most people are focused on and have the most impact on your ability to understand what term of mortgage to take and how long, and with maybe even what lender, because different lenders have different terms that can impact your ability to make an accurate decision. So if we look at current mortgage rates today and what is available. So currently we have high ratio insured 5-year fixed rates from 1.79%. So someone like my friend Ali there, he probably remembers when that decimal place was one position to the right in the late 80s and even as much as right into the early 90s. So this is free money if you've ever been through that. And it should feel like free money for just about anyone if they have any idea about what interest rates have done over time. Variable rates, 5-year variable rates start from 1.65%. This is based on a prime lending rate of 2.45%. Now, a lot of people aren't aware that there's a mortgage out there called a conventional insurable. The key with this is because it's insurable, it's bulk insured by some of the, I won't call them smaller lenders, some of the monoline lenders do bulk insurance on conventional mortgages. You don't pay, the client don't pay the insurance, but you get access to some of the best rates. And those are starting at around 1.99%. And Monday, when I go into my emails, I could get updates and this could be lower. So this was as of yesterday. And the 5-year variable rates on conventional insurables start at about 1.95. Now, the next one that affects people even as more so is when they go to refinance and they want to extend their amortization to, oh, sorry about the spelling mistake, expect that they want 30-year amortization. Well, those rates are starting from about 2.04% for fixed rates and around 2.05% for variable rates. Now, we're here talking to a lot of investors. Well, right now, so lenders have different rates for rentals. Every lender generally has some sort of premium they charge for rental properties. So right now, conventional uninsurable rentals with 30-year amortization, you're looking at a fixed rate of about 2.29%. And the variable rate is somewhere around 2.20% on those rentals. The last one, though, which is really a spectacular thing for those people that are looking just for a home equity line of credit, is that those are starting from prime plus 0.20%, which is a phenomenal rate on a home equity line of credit when you consider most lenders are at prime plus 0.5 or prime plus 1%. So one of the things that we do is you go, well, that's great, but what happens? How do I know if this makes sense to maybe look at mortgage rates and making a change? Well, I have a personal what if calculation that I do. It takes me about 5 minutes, and all the information that I need is what's your current interest rate, your mortgage balance, your remaining amortization, your monthly payment, your length of term that you had, and who your lender was. And then I can do that calculation for you, or just send me a copy of your mortgage statement, and I can use that to do that same calculation for you, comparing your current mortgage to a new mortgage. So if you're feeling confused, this is where you need to use and trust your professionals that you have access to help you get through the confusion. We, I know myself and I know Monica as well, we are watching the headlines and looking beyond just the headlines. Those headlines are there to create intrigue, but you need to dig into those headlines to truly understand what they mean. So if you're feeling confused, talk to those professionals that you're bringing in as part of your team and have them help you understand what they are seeing in the market and what they're seeing going forward. So don't go it alone. Communicate with other investors, find out what they're seeing in the market. If you have rentals and you're having difficulty renting properties, talk to other investors that are renting properties, see what strategies they're using, what they can, maybe tips they might have to help you rent your property out. If you have renewals coming up, what are other investors seeing as far as, are they renewing at higher rental rates or at lower rental rates in your area? Those are important questions and information to get. Leverage your real estate investing groups, whether it's Monica through Guru, or if you're part of RAIN, or any other real estate investing groups. Leverage the information that you can get from them to help you have greater success. Have a team of real estate investment professionals. I'd be glad to be part of your team as a mortgage broker. There's realtors that you can have as part of your team that can provide you with real estate information related to the areas you're interested in. A lawyer that understands real estate investors and works with real estate investors. An accountant that understands real estate investors and works with real estate investors. These are all critical things and critical people to have as part of your team. And create a financial plan. I know that, I'm also a certified financial life professional. And so some of my clients have a poor relationship with money, and they have their financial life is all happened by accident. So I work with clients to create a financial life by design rather than one that happens by accident. And that can have a huge impact for helping people have a more fruitful and abundant life. Set goals for yourself. If you're an investor, you want to set goals and make sure that those goals have a objective for you to meet. And don't make and break them down, because if you set a lofty goal but you don't break it down, the chances of getting there are a lot slimmer. You just want one thing at a time. Set your steps and then work towards it. And avoid shiny object syndrome. It's, I've heard a lot of this because people have been at home, working from home or off work completely, and they're spending a lot of time on the internet. people are looking at, oh, well, that could, what can I do to make money? Well, I can look at this strategy. Oh, I can go over here. Oh, no, I can look at that strategy. Oh, I can go over here. I can, and people are not able to get focused because they think that every person has the next best thing for them, and they haven't done anything to create a financial plan or set goals for themselves. Use those goals in that financial plan to help you move forward in your investing. So if you are looking for information, I do have an app that's available. It's called Mopolo. You can download this through BlackBerry, and as well. So it's at Mopolo. And as well, you can connect with me on Facebook, on Instagram, LinkedIn, Twitter. All my handles are pretty much my name, so I'm pretty easy to find. If you Google me on any of those, or Google me and look me up on any of those. And my personal vision is that everyone shall live a life of abundance. I believe that I do things such as this, and in everything I do every day when I talk to my clients, I'm looking for ways that I can have an impact on their lives so they can also feel that they are able to live in abundance as well, in whatever way that is for them. So there you go, Keith with Mortgage Alliance Enrich Mortgage Group. If anyone has any questions, I'm happy to take those questions now.
Perfect. Oh, Keith, that was wonderful. Thank you. I do have a question, though. You were talking about the bond yields. Can you go deeper into that and let us know how that directly impacts interest rates going forward and where you see that heading into the future?
Yeah, so bond yields are impacted by the movement of cash in and out of the markets. So as people feel they need, mostly it's banks and companies, as they feel they need to move cash to security, they move them into the bond yield market. And this inversely impacts the value of the bond yield. It actually lowers the price of the bond yield. And so that is one example of where you could see that as being less confidence in the market. So that's what pushes the bond yield down. As they begin to gain confidence back in the market, they start to move cash out of the bond yield and into the markets, thus pushing the bond yield up. And then inversely, directly related is the fixed rates, which will continue to move up with it. So that's why watching the bond yield can give you an early indicator of how other organizations or large investors or the banks are feeling about the market, is because they will start moving money from cash into other investments. So they move them out of the bonds into other investments first.
Okay, and these bonds, are they government bonds?
Yeah, it's based on the government. That's based on the 5-year. So that chart I showed was the 5-year Government of Canada bond yield.
Okay, awesome.
Yeah. And you can look at the 3-year bond. There's charts for 1 year, 2 year, 3 year, 4 year, 5 year, 10 year. The 5-year one is the most common one that people look at.
Okay, perfect. And so do you think that the interest rates will stay low for a very long period of time, or what is your thought on that one?
I believe we're going to be in a low interest rate environment, I think, until at least the beginning of 2021. There's so many things that are going to happen. So we're in the fall here. So one back to school is happening, and nobody knows exactly what's going to happen as far as the virus and the pandemic in Canada, anyways, going back to school. We've already seen what's happened in the US and some other countries where they've started going back to school. So that's number one. Number two, we have a minority government, and there's a lot of speculation that the opposition parties are going to do a vote of non-confidence when they return to Parliament, and we're going to end up in an election situation. So that's number two. Number three, we have a US election, and typically mortgage interest rates do stay low in Canada and until such time as the US election finishes, and based on that result, that can have an impact. Now, it may not have as much of an impact this time because it's not just the US election that's happening. There's so many other things going on. Right. As well, the other major impact economically is mortgage deferrals. A lot of people took mortgage deferrals. 15 to 20%, depending on what statistics you look at. And a lot of those people those deferrals are ending in September. So
what do you think is going to happen when those deferrals end?
Well,
got a lot of defaults?
The one stat that's not available or has not been produced is how many people took deferrals just to take them. Because I know that with clients that I have several clients that took deferrals just to take them. I've only had one client that took a deferral because he actually had coronavirus.
Wow.
So, and he was off work for about 6 weeks, and then continued with the deferral for about 2 months after that. So there are a lot of people, and there are many investors who took deferrals. So that stat is going to be tough to read until we get to the end of 2020 and into 2021, when the arrears of mortgages that are 90 days plus, because that's where they don't start reporting them, is until they're 90 days in arrears. Right. Until we start seeing those statistics come out, that's when we'll have a clearer picture of what the impact is of people that haven't been able to go back to work or have lost their jobs. So, if the economy and if we continue to see job vacancies improve, we'll see less likely to see those things happening.
Okay, so so for those investors who did take a deferral, are they looking at larger mortgage payments in the future, or how is that going to impact them?
In most cases, yes. If you took a deferral, you'll be looking at a larger mortgage payment, either at renewal or at the completion of the deferral. It depends on your lender. The lenders did not have to use one specific method or policy to that. So that is a specific thing to your lender, and they should have provided you, when you took the deferral, you should have received a letter from your lender that described what that was going to look like for you.
Okay, so that's something. Did anybody here take a deferral for their mortgages? If you want to write that in the chat box, I'm just wondering what your terms were. Are you going to be having a higher mortgage payment when you have to go back to paying, or did anybody?
Yeah, and some of them aren't applying. Something like, I know that, for example, TD at renewal is when they will be applying the deferred payment amounts to your mortgage and affecting your payments. Other lenders are doing it as soon as your deferral's done. So that's one of the things. I see VK has the question. Yes, this is related to Canada, not related to the US. I don't endeavor to say that I know what's happening in the US. As far as I know that their unemployment is some of the highest ever, and that their economy is really struggling. And so other than that, that's what I know. I don't get into their mortgage interest rates or their bond yields or their economy deeper than that. So.
Yeah, but VK, we will be talking, or I am going to be doing a presentation just shortly that will be covering other markets as well. So while the mortgage stuff that Keith is talking about is Canada specific, I'm going to be talking about some economic indicators that will be reaching further out than Canada. So stick around for that.
Yeah, and on the topic of deferrals, for people that took deferrals, what a lot of people did not realize, although it's not a negative impact on your credit bureau, a lot of lenders are saying, we'll not lend to you while you have a mortgage, a loan, a car loan, a credit card that's in deferral. We won't lend to you in that situation. It needs to be out of deferral, and it needs to be updating on your credit bureau that it's no longer in deferral. So that is something that we are now running into with lenders, is that those deferrals, as much as great as they were, now if you're looking to take action, it could impede your action for because it could take up to 6 weeks for you to get an update on a deferral. So, because depending on when your lender submits their updates, can be a huge factor. And some lenders won't even let you submit. They won't even let us submit a file to them unless that credit bureau is clear of deferrals.
Okay, so if you're an investor who's taken a deferral and you want to buy some more real estate right now, you're potentially going to have some issues then, is what you're telling, what
Yeah,
you're kind of
absolutely.
getting
Yeah.
from here. Okay.
Yeah, I have some investors that were looking to refinance, and the lenders have said, nope, as long as they have something in deferral, we won't do it. Um, and yeah, it's been tough. And in one situation, although they had deferral, they had to cancel the deferral. We had to get a specific letter from the lender that they had the deferrals with, outlining that it was no longer a deferral, what the current balance was, what the account number was, what the monthly payment was that they were resuming. And so it delayed the process because we had to go and get that. So
Wow. Okay. Well, I'm glad I was rejected for a deferral. When I called in when it happened, I was quite certain I was going to lose my job, and I did end up losing my job, but they said I wasn't qualified, whatever that means. So I'm actually really happy that that it wasn't qualified now that I'm hearing all this. So that's awesome. Thankfully, all my tenants paid their rent. I'm fantastic at picking tenants, so what can I say? So that's awesome. Awesome, Keith. So I forgot to ask you, how did you even get into real estate? What's your journey? How'd you get there? How'd you get into mortgage broking?
yeah, so my real estate investing career happened back in 2003 is when it started. My wife Nancy and I bought our first place was a condo we bought for my mother-in-law to be able to live in and rent. That's when rents were, if anyone from Calgary realizes, or Alberta, rents really started to increase around that time. And so we wanted to be able to offer her a place that she would have a fixed rent without having to worry about rental increases. So we bought a condo, and had her live there. She lived there for many years. She moved out of there, I think about 5 years ago now, is when 5 or 6 years ago, she moved out. She wanted to move into a seniors living complex. And so, yeah, and we still have that condo in our portfolio and have tenants there. So that's when we started. We really started kicking it into gear. Our next property was a flip property in Calgary, and then we followed that up with actually purchases in Saskatchewan. We do own properties in Saskatchewan, and we still own actually all of those properties that we've purchased in Saskatchewan. They've been some of our best performing properties that we've had. So that has been a great thing that we've been able to do as part of our ability to maintain our investments and our cash flow. We haven't seen our rents really dip in Saskatchewan during the last 13 years that we've been investing there. When Calgary was going through reduced rents in 2008 and 2009, and in 2014 or 2015, 2016, we've been fortunate. We've never experienced that big of a dip there. So.
Wow, that's awesome.
And then, yeah, so we currently own 15 doors. We've been we've done, I think, 6 different types of joint venture partnerships. Some of our joint ventures are now 13 years long. Other ones we've had client that, people that have retired. So we've sold properties because they've decided they retired and they wanted to divest. So we've done that. And I moved into the world of finance. I started the world of finance in 2014 and became a mortgage broker in 2016. I was with a private lender prior to becoming a mortgage broker. And and I haven't looked back. It's been a phenomenal change for me. I love it. I love what I do as a mortgage broker. I love real estate, getting to talk to people about real estate every day. Getting to work with members, and it's it's something that I just love to do, and it helps me to be able to fulfill my personal vision. So
It's amazing, and it really shows, Keith. I mean, I've seen you speak on the RAIN stage many times, and you were always so enthusiastic as you are today, and it's been wonderful. Does anybody have any questions for Keith about his presentation today, or anything about mortgage lending at this time? This is a great time to ask some questions. We've got an expert here, so take advantage of this time that you have. Anybody have any questions? Type them in the chat box.
So one of the things that a lot of people do ask me about when they come to me as a mortgage broker and they're investors, okay, is they do ask with regards to either the number of properties, how many properties can I own, or how should I own these properties, or you know, how does cash flow get calculated? So those are all some of those questions are very specific to the holder, and so based on what they've already done with their portfolio can impact what we have the ability to do for them. So that, you know, you can own multiple properties. How those properties have been set up with lenders prior to coming to me can have an impact on what we have the ability to do to try to help them continue to grow their portfolio. When it comes to looking at cash flow, every lender has their own different cash flow analysis that they do on rental properties when you own them. So that differential is huge and can make a difference between qualifying at one lender but not qualifying at another. And some lenders have a restriction of what loan to value they'll do on a refinance. There's many lenders that will lend 80% on a purchase, but there's not as many that will do that on a refinance. So those are big things to consider in that environment. See, David posted a question there. What is the spread between the bond yield and a 5-year mortgage? So David, if you're referring to the high ratio mortgages, the current spread is about 1.5% on the 5-year bond yield. So it anywhere from, so yesterday, the lowest fixed rate we have right now is 1.79. The bond yield was at about 0.36, 0.37 yesterday. So you're looking at a spread of 1.42 on that. So that's what the spread is on high ratio mortgages. On conventional and uninsured, the spread is certainly much more significant. It's more near the 1.8 to 2%, depending on the lender, is the spread on the conventional mortgages for rentals.
Perfect. Keith, so Wendy also has a question. How is a rental property viewed by a lender? Do they take rental income in the calculations?
So Wendy, yes, they do take rental income into the calculations. And a rental property, rental properties are viewed as a supportive income. If you are strictly relying 100% on your income from rental properties, you're going to be outside of the A lending world, because they just do not like to have investors that have 100% of their income from rental properties. However, when you are looking at buying a property, different lenders have different policies again. Some will only use 50% of those rents on the subject property to offset against the due debt of that property, the mortgage, the principal, the interest, the taxes, and the heat. Other lenders will use potentially up to 80% of that calculation to offset. So it really, and again, as I mentioned before, there could be a loan to value limitation that comes with the lender that uses the higher calculation versus the lower calculation. So again, it's what if, right? What is your story? What is it that you need? How much down payment do you have? So that's an important thing to take into that consideration for those calculations. And then if you have non-subject rentals, that's a whole nother set of calculations that have to be done.
There's another question from Debbie that I find interesting. So how are lenders looking at real estate investors during this time if they haven't gone back to work yet, or they've gone back part-time? If their incomes have dropped, are they having trouble right now?
So it all boils down to debt service. It boils down to debt service ratios and whether the income that you've now got. So if you've had to shift from full-time to part-time, do you have guaranteed hours at that as that part-time person? So if you have a guaranteed hours and guaranteed income as that part-time role that you're now in, that's the income that they will use for calculating debt service ratios. So that's one of the things that unfortunately they won't look at your previous income and say, oh, well, because of your prior income, we're okay. It's more going to be based on the fact that your role has changed from full-time to part-time.
All right. And so David also has a question. He says he's got 6 rentals and he's wondering if it's better to have a few different banks with the mortgages or just stick with like 1 or 2. Is it better to spread yourself out or?
Yeah. So David, that's a good question because it really boils down to what is your plan beyond those 6 rentals. If you are still wanting to grow and increase your portfolio, then that's where, you know, for me as a mortgage broker, I'd have a conversation with you about what lenders are your current mortgages at for those 6, and are those lenders that actually we would prefer to be able to use to help you grow your portfolio because of their lending rules, or are they lenders that right now are okay because they will allow us, because of their rules and other lender rules, we can still grow your portfolio. So it's not as simple as straightforward. You know, I know investors that have many rentals with different banks, and some of that is dictated by whether there's been a refinance or just a purchase. Because if all you're doing is purchasing, if you're purchasing properties and not refinancing, the lender choices will likely be different than if you're looking to refinance, because there's less lenders who are eager about refinancing to 80% loan to value on rentals. A lot of them are limited to 70 and 75% loan to value on rentals, unless and some may give an exception if you've got really strong credit and really strong net worth and a really strong primary income that you have to support your costs related to your rental properties if something were to happen. So those are some key things.
Okay, I actually have another question for you, Keith. So the stress test came in 2018. I remember it well because that was like the mark where I all of a sudden didn't qualify for a mortgage no matter what I did. So how have you seen an impact to investors since that's come in? And how do you see that?
Yeah, the biggest impact on investors for the stress test is related to their subject properties, and because the subject property they're taking away a significant portion of the rental income. So in most cases, taking away 50% of the income, but requiring you to use this benchmark or stress test rate of mortgage plus 2% for qualifying. And so what that's doing is pushing the gross debt service percentage up for the qualifying. And if you've been a person who's been buying properties based on strictly market value increase and not focusing and worrying about your cash flow and having good cash flow on properties, those investors are the ones that really are struggling to be able to qualify for mortgages. The days of just buying rental properties and focusing on the equity value increase really is going to limit your ability to expand a portfolio, because you're going to use up your capacity on the debt service side very quickly because of shortfalls that even though you might be breaking even depending on the market, that could end up being a $400 or $500 a month shortfall in the calculation that the lender does using a rental worksheet.
Wow, that's a really good point, Keith. So cash flow really is king. It always has been, but now more than ever, you may not be able to get financing if you don't have good cash flow, is what I'm hearing from you. Is that correct?
Absolutely, yeah. Cash, because that's what the lenders are using based on that. So even the way you're having your accountant take deductions, because some lenders not all, but some lenders use the expenses that you've recorded on your T1 general as the ruling outline for what they are taking for deductions on their rental worksheet. I had a client just the other day who had $1,700 of office expenses declared on their rental on the T776 rental statement of rentals, and that was on several different properties, and it's now cost them a huge amount of cash flow that's used in that lender's calculation. So sometimes you have to really be cognizant of the things and how you're having how your accountant is taking deductions and where. Having your accountant take deductions that are non-rental property deductions from your rental properties might not be the best solution. There may be another solution that you should be creating you should have maybe a separate business entity based on how you're operating your business that you should be doing, or who knows. But those are things to consider with your accountant when they're doing your taxes. So I know we often in life, many people are focused on paying as little tax as possible. And I get that. I understand that. I want to pay as little tax as possible too. But I also know that if I worry about paying too little tax, that's also going to impede my ability for growth and wealth, because I'm going to hit a wall in how I can get financing, because I'm now showing little income or no income, or I'm showing negative, if I have a corporation, if I'm showing negative retained earnings, now I can't even use my corporation to help support my income situation. So it's something that people really need to be aware of and cognizant of.
Wow, that's a really good point. I know so many people who are so worried about paying taxes and they're trying to lower their income as much as possible, but really it could be hurting them in the end. So yeah, this is a bit of a chess game. You need to really put your ducks in a certain row, or you're just going to be hurting yourself when it comes to purchasing the next property. So I love that you mentioned that. Debbie's got a really great question too. She's saying, what is good cash flow? What do banks consider as good cash flow?
So if you follow the model of doing a cash flow analysis, which is you've got your rents minus a market vacancy for your area. Typically, if you use 5%, you're going to be in line with what the banks will use, minus your insurance, minus your taxes, minus your mortgage, minus probably a 10%, 10% for property management, and 10% for maintenance. That's kind of the basis of the calculations that most lenders are using, is that formula. Now, if there's additional, like I said, if you have additional expenses such as that you're taking on your T1, such as professional expenses and office expenses, those can be additional deductions that end up happening from some lenders. So that, if you do that calculation, now you're looking at what the cash flow looks like on your properties from a lender perspective. That's going to be fairly accurate. I find that in most cases, you need to have somewhere around $400 to $500 a month positive cash flow for a property to work out as being seen as a positive or a break-even cash flow on a lender's worksheet.
Okay, and I really love this question from David because I'm a stock investor too. So I'm actually really curious about this as well. How do the banks look at dividend income in the calculation of mortgage calculation since he's about to retire in 1 to 2 years? How would that look on there?
Yeah, so if it's dividends from investments, lenders are okay with it, but they want to see that consistency for at least 2 years. And they will take an average of those 2 years, or if the current year is lower than the previous year, they'll take the lowest of that. So an example of that is if in 2018 you had $25,000 of dividends, and in 2019 you only had $23,000 of dividends, they will use the 23,000. Now, if we reverse that and you had 23,000 in 2018 and 25,000 in 2019, they would use a 2-year average. So the income they would use would be 24,000. And they will ask for copies of your T5 slips to show where those investments came from. They'll ask for a copy of your investments to see that you can maintain that type of withdrawal for an extended period of time to cover and pay for your mortgage.
Wow, that's fantastic.
Now, if that dividend income is from a corporation, then they're going to look at what does the corporation do? What does the financials of the corporation look like? Is there, that's a whole nother scenario under a business for self. That's a consideration. So.
Okay, but they will take the whole amount into the.
They will take the whole amount of dividends as long as it looks like it, as long as it can be proven that it has been happening for at least 2 years, and if it's from investments, that it looks sustainable.
Love that, because sometimes in real estate they only take half of your income there. So stocks sound pretty good to me when it comes to dividend growth. That's for sure.
Yeah.
So that's awesome. All right. Is there any more questions? Does anybody have any more questions before we move on to where we are at in the real estate cycle? No.
Well, thank you, Monica.
Thank you, Keith. I really enjoyed your presentation. Thank you so much for giving us the update that we all need when it comes to mortgage lending. I hope you stick around and fire some questions at me, because I've got a whole bunch of economic things I want to go to. So it'd be nice to get some feedback from you as well, since you're an expert in the field as well. So what I'm going to do is, so if you want to give me back host, I'll put up.
I did do that. Double check. You should have it.
Okay, let me see here.
And I'm just putting my contact information in the chat there for everyone as well. You feel free to email me, and also my number's there as well.
Okay. All right. Let's see if I can share my screen here. Oh, it's not doing.
Yeah, you're sharing.
Hold on, it's not sharing my presentation. Where did my presentation go? Here we go. Sorry, let's see. Oops. There we go. Okay. All right. So thank you, Keith. So I am obviously Monica Guerrera from the Guru Intelligence Network, as I introduced myself earlier. And just give me a second. I'm going to let my chat box go so I can see your questions here. So, I'm going to be talking about the real estate cycle, where we're at now, what's happening in the economy, which real estate investors need to be watching, and what strategies we need to be focusing on right now. So this presentation was actually going to be done by Jennifer Hunt, Vice President of the Real Estate Investment Network. Unfortunately, she had an emergency, was unable to make the presentation today. However, she did send along some free bonuses for all of you who are attending today. So Real Estate Investment Network, they put out a lot of research on real estate investing, if you're not familiar, and they are offering 2 free RAIN research reports to anyone who's attending this event. So there's the coronavirus impact on Canadian real estate is the one report, and the other one is the COVID-19 special edition real estate cycle, the May update. And to get those, just email Jennifer at raincanada.com, and she'll be happy to send those your way. So I'm going to dive right into my presentation. I've got so much to talk about today. There really isn't enough time to talk about it all. So the main things we're going to be talking about is just going to start out with this wonderful quote from Warren Buffett. And he says, when the tide goes out, you discover who's been swimming naked. Now this is the time, guys. The tide is starting to go out. So the question is, are you swimming naked? Okay, so hopefully you're not, but you'll get some information today. So maybe it'll help you figure out what you need to do going forward. So to begin with, I'm going to be talking about the Canadian real estate cycle and where we're at now. The real estate cycle is the same no matter which country you're at. Any democratic country will follow the same cycle. So you will be more familiar with your own jurisdiction. So if you're in the US, you can probably find through these slides that I'm going through where you're at in your particular jurisdiction. And as we know that real estate is actually a local thing, so the real estate cycle might be slightly different in different localities as well. So I'm going to be talking about the cycle in general in Canada right now, but obviously we have to keep in mind that each center is going to be slightly different in their cycle. So the economic factors that we need to be watching as real estate investors as well is something that I'm going to be going over, and how these factors may impact real estate going forward. I'm also, after we go through that, we're going to talk about which strategies we need to focus on and which ones to avoid right now. So if you haven't seen the real estate cycle dial or clock yet, so this is from Don Campbell's Secrets of the Canadian Real Estate Cycle book. He is actually the father of the acre system, the real estate investment network as well. He is the guy who I consider basically inventing cash flow real estate. Before he came around, no one really had a system and they were just kind of muddling around in real estate. And now real estate investors everywhere who learn the acre system are making money following the system. So the system is based on this, the real estate cycle. So the real estate cycle has 3 different stages. There's a recovery, boom, and a slump. And when we're in the recovery boom phase, you're going to see rising real estate values and rents. It's kind of what we've been seeing now. As Keith mentioned, we've been seeing some pretty incredible increases in property values lately. And then once the boom ends, we start going into a slump, and then we start seeing falling real estate values and rents. And what goes up must come down in real estate. This is a cycle, and the higher it goes up, the longer it lasts, the harder it falls. Okay, so which is really something we need to be watching right now, because we've never seen real estate values as high as they are now, and they've been high for a long time, guys. So we are looking at potentially a really deep fall soon. So just stealing from Rain's research there, from Jennifer Hunt's research, we've got the Rain long-term real estate success formula. So what we've been seeing over the last few years is the upward trend. So now we're in the top end of the arrow here, which is increased property prices. And so now what we're actually starting to see is the downward trend. So when we go into a downward trend, we start to see a drop in GDP and growing unemployment. And as we all know, with the pandemic, we've seen unbelievable amounts of unemployment in the last few months. I mean, we've never seen anything this big ever. And then we start seeing population decline. We are seeing that as well as immigration rates fall due to closed borders. I'm just gonna pull up some of the excerpts I found over different sources about what's going on in the market right now. So July 20th, Terranet said that even though the house price index was up in many centers, overall, there was signs that the market is starting to decline. So in June, we saw the first retreat It was a very small retreat, barely noticeable by most of us real estate investors, but there is signs of that market slowing down. So as you can see here, most of the country is doing pretty well when it comes to property prices, except for Alberta. So obviously Calgary, Edmonton have had negative growth in prices after the slump in oil prices in 2012. Alberta's pretty much been in a slump and stagnation of prices since then, and we're seeing that it's continuing forward. So just out of the real estate cycle book, this is just a depiction of what happens in the real estate market. So what we are seeing, so we had a nice dip in 1983 after a big high, and then we had so the real estate cycle goes up and down, as you can see here. Kind of looks like a stock chart, right? So when there is a high, then we've got a low. So interestingly enough, the real estate cycle takes about 12 to 18 months from the high to get to a low. So if we look at the last couple of downturns that we've had, so in 2008, 2009, we had a really big downturn with the subprime mortgage crisis. And that actually started seeing signs in 2005 that it was going to happen. There were a number of economists on the inside that were warning of this, but none of the media was actually paying any attention to that. And so what was happening in 2005 is we were seeing a really hot market, just like we're seeing now in many centers, where real estate prices were climbing like crazy. There were multiple offers all over the place. I remember this very clearly because I was a realtor at the time, and it was crazy. I mean, I had one of my clients trying to buy a tiny little townhouse, and there were 12 offers on it. It was just insane. Shortly after that, I saw a massive drop in my real estate sales, but also the entire market started to fall. They didn't actually call it a crisis till about 2007 when we saw the low there. But you could see that there was a big downward trend from 2006 on. So going forward, this only goes to 2010, but if we were to extrapolate this, we would see this line go upwards and be at a higher peak right now than it was back in 2007. And it really looks like we're at a peak and about to fall. So some of the key drivers that run the real estate cycle are demographic, financial, and emotional. These directly influence supply and demand, and each driver tends to increase over time until it reaches a peak and then it declines. So if we look at demographics, demographics has a number of facets to it. We've got migration, employment, home sales, rental vacancy, and housing starts. The migration numbers right now, so I was just looking up to see what those were. So we've actually seen a decline of 64% of our immigration rate as compared to last year at the same time. So that's a huge, huge decline in population. Immigration actually accounts for most of Canada's population growth. It is how Canada keeps its economy growing. So it's going to definitely be hitting us in our real estate prices at some point with a decline in immigration. And then we go into employment numbers. So obviously we've had a massive decline in employment. So these are employed persons in Canada. So as we can see, before the pandemic hit in March here, we had a pretty steady level of employment across Canada. And then in March, when the pandemic hit and the borders started shutting and all the lockdowns started happening, then we started to see a massive decline in employment. So we hit an all-time low in April when the lockdowns were in full swing. And in May, we started to see a slow increase in job growth, mainly as employers started to figure out how to get their employees working from home, I would think, because we were still pretty much in lockdown then. Maybe a few places were starting to open up, but I think many of these might be because of some pivoting that businesses have been doing. And we've seen a steady growth into July in persons employed. However, as you can see, we're not anywhere near where we were at levels before the pandemic hit. Now, so what we're sitting at right now is about 12.3% unemployment rate in Canada. I do believe this is a low figure. These are based on obviously stats of people who are on the CERB right now. There are quite a few individuals out there that did not qualify for the CERB, or so I do think that number is much higher. And the thing to note as well is that number of full-time jobs is decreasing. Most of the increases are from part-time work. So we're starting to see an erosion of the quality of jobs that is out there as well. And as far as home sales go, so as Keith was saying earlier, the home stats are going crazy right now. Prices are going up. Their sales are actually increasing at this time, which is something that we do see right before a dip happens. And so just wondering, so what are the chances we will see a huge spike in pent-up immigration? That's a good question. We definitely do have a pent-up in immigration right now. The government is letting people in. The problem is they're not able to get in, many of them, because of the lockdowns and the border restrictions. So hopefully at some point those will be lifted and we might see actually a surge of immigration coming into Canada. However, there's also the issue of trying to get all that paperwork done. And as we know, our governments aren't really good at making that a quick process. So we'll have to watch and see what happens with that. So as far as home sales go, we've got a really interesting trend between Canada and the US. So Canada is the red line here. So our prices for homes have gone up incredibly since 2005. As in comparison with the US is much lower than we are. I think much of that has to do with probably economic stability. I know in the recent years, there's been a lot of foreign investment in Canada looking for a safe haven for money. And some of that has come from investors trying to protect their money in real estate. And also all the immigration that's been happening. So I saw a stat earlier that said that over 80% of new immigrants come with money to buy a home. And most of those see Canadian real estate as cheap. And so they're willing to pay a little bit more than the average Canadian consumer. And that's been helping to drive the price up. So housing starts is another really interesting stats that came out this week. I mean, they are going out of control as well. They're really high right now. There's a lot of people out there buying new units we've been seeing huge jumps in companies who do develop new housing as well. Their stocks have gone up because they've seen some massive increases in sales as well. So this is just a visual depiction of what's going on with housing starts. So you can see April obviously is the low, and now it's just, it's blown away 2019 numbers, which is really incredible considering the type of market we're in. So if we go to rental vacancies are at their lowest actually in most cities in Canada. So we've been seeing some rising pressure, particularly in our rents, especially in larger centers in Canada, such as Vancouver and Toronto. In Alberta, we haven't seen it as much, but of course we've been in a slump. But the rest of the country has had a real supply shortage, and so rents have gone up, and we're still having a supply shortage when it comes to housing. So this is a little graph just showing what the vacancy rates have been doing over the last several years. So they've been going down. So if we look at some financial drivers, these are some of the things that drive the financial markets. So we've got viability of real estate as an investment, or being able to afford it for ownership. Rental levels as well, supply and demand always plays a key in pricing and financials. Return on investment, this is something as real estate investors we focus on, or should be focusing on right now especially. As income levels start to drop, as we've seen with employment numbers, affordability is going to start being an issue. Also, availability of financing is going to tighten up as we start seeing the levels of bankruptcies go up. And then eventually that will impact real estate values. So some of the things that influence the markets that we need to be paying attention to right now is interest rates. And I know Keith was saying that interest rates are going to stay low with the Bank of Canada. And they've actually indicated that those rates will stay low for at least 3 years. They don't plan on increasing that. However, we need to dig into that a little deeper. So I'll be doing that shortly here. We're also going to need to look at the availability of financing and the ease of borrowing. So how is this market going to change the rules for borrowers? Is it going to make it easier or harder to obtain financing? Another thing we need to be looking at is inflation. As our governments are printing money like it grows on trees, we will likely start seeing a devaluation of our money. And we're already seeing inflation in a lot of markets right now that we need to be paying attention to, particularly in materials, because we're starting to see supply chain issues around the world when it comes to commodities. Another thing we really need to be paying attention to is taxation, because at some point when the government stop printing money and trying to keep the economy afloat, they're going to have to stop those programs or ease them and try to reverse all of that spending. And there's only two ways really that they can do that, and that is to increase interest rates and to increase taxation. So that's something actually that they are looking into, and I'll be going through some articles here in just a second that prove that. So the other thing that we need to be paying attention to is a foreign investment. So Canada has generally been a safe haven for other countries when it comes to foreign investment, but we're seeing a lot of trade issues constantly. We've seen it over the years with China and the US with tariffs and so on. So we need to be paying attention to how that's going to impact us, because that's going to directly affect jobs and the incomes of Canadians, and how much real estate is going to cost. The other influencers are also the availability of other alternative investments. So if real estate starts to be less attractive or less able to get in, maybe some other alternative investments will take its place. So just a little bit of home buyer stats. What we're seeing, that is average Canadian's net worth is tied up in real estate. So the reason I was mentioning the taxes is because this is what the government of Canada is looking at. They're looking at, okay, we need to increase taxes at some point. So where do we do that? Where's all the money? Well, it happens to be tied up in real estate. So the majority of Canadians' net worth, over 60% of Canadians' net worth, is actually tied up in real estate. So guess what they're going to end up, what they're looking at doing? They're looking at taxing our homes, yes, our homes and our investments. So this was an interesting graph that I found. So this is basically the average portfolio of an average Canadian here. So we're seeing that most people will have a primary residence, and then a lot of them will have a secondary, either vacation property or an investment property. And then, so we've got about 3/4 of their holdings are actually in real estate. And then they also have a little bit of pension, RSPs, other stocks. So this little quarter here, primarily tied up in the stock market, okay? So we're looking at taxation. So July 17th, there was a big announcement that from CMHC that they've been hired to do a federal income tax equity research project. So if that doesn't say that the government is trying to tax our homes, I don't know what is. They've spent billions of dollars on $6 billion on this research. So clearly they're looking at taxing our homes. It hasn't come in place, but we need to watch that and how that's going to impact our real estate investments. So the key findings in the Canadian Financial Capability Surveys is actually quite worrisome. Canadians are in debt, and this is in 2009, before the pandemic. 177% of disposable income in the average Canadian household was going to debt. This is crazy. So this is before the pandemic hit. So we can see that you know, the reasoning behind money being printed right now is that Canadians are having trouble keeping up with their debt. And these stats are even more worrisome for people who are 65 and over, who most of them claim they're just having difficulty paying their bills right now. So we've got an aging population who is in a downward slide right now, which is very worrying right now. So a lot of that debt, interestingly, is tied up in mortgages. So, and also about 13% of Canadians have a home equity line of credit on their homes as well. And then we've also got other types of credit, and these are the ones I'm more worried about, is the ones on credit cards, vehicle loans, personal lines of credit, student loans, basically consumer debt, which has actually been really easy to get over the last few years. So after the subprime mortgage crisis happened, it's gotten really much harder actually to get a mortgage. However, the other types of credit have been really easy to get. And so a lot of people have been jumping on board. And yes, they are starting to pay off their credit card debts, which is a really good sign. I'm just wondering if it's a little too late with the economy going down as it is. So affordability wise, what's going to happen when our tenants who have opted to not pay us, will they be able to pay us back? Well, the question is, if they weren't able to pay us before, are they going to be able to pay us more later? So, so we've got the residential eviction ban is going to be lifted September 1st in BC, and I do believe other jurisdictions are going to be following towards this. So just to give an idea of what the average renter is looking at who has taken this option. So a renter owing 4 months rent at $2,000 is $8,000 total in unpaid rent, now have to pay back their landlord by July 2021. And so they need to be adding $800 a month to each of their rental payments to pay that back. I don't know about you, but I'm not sure our tenants are going to be able to afford that, especially if they may still be jobless right now. So that may impact a lot of things in, especially in the rental housing market. But this is also going to be showing as evictions, because landlords will be able to now start to evict tenants who are not paying. And when it comes to financing, so introduction of the stress test in 2018 has removed the ability of home buyers and investors to enter the market. A figure I saw was about 20% of people no longer qualify for a mortgage. I'm one of those people. I can no longer qualify based on the new rules. However, this is something that is probably really good for the Canadian economy, in that it's helping to reduce the amount of debt that Canadians hold. But I think the problem is people are now shifting into consumer debt, which is a lot higher in interest rates rather than mortgages. So I'm not so sure it's really helping. Okay. So what we talk about interest rates now, I really wanted to dig deep into the interest rate issue, because that's something that we're going to be really impacted as investors going forward. So I wanted to know what the heck determines the Canadian interest rates and interest rates in general, because I know I don't pay the Bank of Canada rate. The Bank of Canada rate is what, 0.25% right now, Keith? It's low, but I don't know. I don't pay that rate, and I don't know anyone. There we go. Yeah, I don't know anyone paying 0.25% on any loan that they've got right now. So where's the gap here? How are interest rates determined? So I actually did some digging into this, and so interest rates are determined by a number of factors, actually. And yes, the Bank of Canada is one of those factors. But there's also supply and demand for loans, availability of lending capital. Our interest rates are actually highly based on what the US does as well. If you notice, once the lockdown started and the Bank of Canada started dropping its rates, the US would drop their rate, and the very next day Canada would. So whatever the US does, we tend to do like right after. So we need to be watching what the US is doing with their interest rates, because chances are we're going to be doing that too. There's also inflation rates that impact interest rates, and other economic factors that control interest rates. So the main interest rate factors that will be impacting interest rates into the future. So they'll stay low for now, for sure. But the things that affect interest rates is the risk to the borrower. So with consumer debt, for example, on a credit card, most credit cards have very high interest rates, 28% or 30%. On the credit cards. And why is that? Well, it's because it's a very high risk to the lender to lend that money. There's no collateral there. There's a lot of default in credit card payments. So the interest rates are high because they have to be able to make money off that money that they're lending. And also, the longer that the money is being lent, the more risk that the lender has, because inflation will actually reduce the amount of money that comes back to them. So, so if you're looking at a 10 or 20-year mortgage, you're going to be paying higher interest rates because you're borrowing for a longer period of time. Now, inflation is another big one, because that's something that's going to be that's on my radar, especially because that will also affect, as I said, how much the lender will receive. Now, in the 1970s and 80s, when we saw some really crazy interest rates up to above 8%, there was a point in time I heard that people were walking away from their houses because their interest rates were so high, upwards of 20%. They found that uncertainty was a really big factor into interest rates, and as we know right now, everything's uncertain right now. No one's got that crystal ball. No one really knows what's going to happen. So that can play a really big factor in what happens in interest rates as well.
Monica, that what you just said is reflective of what happened early in the pandemic,
Right.
when there was so much uncertainty with as far as employment and stuff. The banks were really had no clue as to what people's employment situations were going to be and their ability to repay. So they, even though the bond yield really dropped off fast and in a hurry, took them a long time to start dropping interest rates to a point where they felt more comfortable with people's ability to pay. So that was a direct reflection of exactly what you just said.
Right. Yeah. So, so if you're only looking at the Bank of Canada rate, like you're missing the boat here. That's only a small fraction of what determines actual interest rates that we pay. Okay. So that's right. Yeah. The lenders are really reluctant. I mean, I contacted my lender and they did not want to give me a deferral, and so they were. Yeah, it was just uncertainty at that time, and so I saw it directly with the lenders that I was trying to deal with as well. Now inflation, this is a crazy number that just came out last week. Lumber prices, okay, this is just one commodity out of many that are having supply shortages right now. They've tripled since May. So if you're a renovator right now, you need to be looking at what your costs of materials are going to be, because it looks like they might triple. Okay, so if we're looking at cash flows on our properties right now, and if you're someone who does renovations or flips, this is something that you need to be paying attention to, and you need to be factoring that into your cash flow numbers. Now, there's also emotional drivers. Now, real estate and the stock market, actually any market, has a certain component that is emotional driven. So it's all about whether or not people are confident in what is going on in the market. And right now, people are really confident because the interest rates are low in real estate and there's pent up demand. I have a theory that maybe some people are wanting to hunker down, so they want to buy their property. This is their last chance. They all feel like it's the fear of missing out. They want to get in the market before it's too late. So that's probably part of what the pent-up demand is all about right now, and the increasing prices. But very soon we will be starting to see some fear in the market as we start seeing some bankruptcy rates come in, and more unemployment rates, and some of the stats coming in that will likely not look very good. So some of the things that drive emotions is the average days of market, number of listings and sales, so supply and demand again. Revitalization, so certain areas will have some good revitalization and others will have a downward trend. The fear of missing out, as I mentioned, and of course, fear of the virus. I mean, everyone's scared of what's going to happen if there's a second wave. And of course, we're all worried about the economy right now as well. So the trends that I'm seeing right now is, so the GDP is going up. Unemployment rates are going up as well, or sorry, GDP is going down, sorry, not up. GDP is going down, unemployment is going up. Again, this week, some stats in the US came out about unemployment rates in the US. And of course, Canada, we're not insulated to this. Our numbers are very similar. We don't have the stats out yet, but I would imagine based on a per capita basis, we're seeing similar numbers. So in the United States, this number is mind-boggling. 1 million people are losing their jobs per week. Okay, and at the height of the pandemic, that number was 7 million jobs per week. Okay, like if that's not a mind-boggling number, I don't know what is. This is just crazy, crazy numbers. And I've seen stats, some economists, they're all predicting different numbers, but I've seen numbers between 20% and 75% of businesses that will be going bankrupt very shortly. That's a huge, huge number. That's a huge number of job losses. These numbers also apply to Canada, not just the US. Okay. And also one thing I am seeing is that as we saw the debt numbers, we have a highly over leveraged population, and we're not talking about just individuals but also corporations. Because it's been cheap money for the last several years, corporations have been borrowing money like crazy, and governments, as we all know, where we've got a federal debt right now. Actually, every level of government has a debt right now that is sorry, that is just spiraling out of control. So we need to be watching that, because that's going to be impacting, well, everything really. There's really going to be a credit crisis coming soon. So so the other thing we're looking at is, because governments are printing money like crazy, we're going to be looking at our value of money dropping. We saw this in the Great Depression of 1929, where money was worthless. I mean, there were reports of people saying, you know, they would go to the bakery with a barrel of money and come out with a loaf of bread. So is this something that we might be looking at in the future, with our money being basically worthless? Not only that, our federal government has dropped in our lending rating. Of course, now I can't remember the term, but we've dropped from a AAA to a AA rating, which means we can't borrow money at good rates anymore, okay, as a country. And that is a very worrying thing, seeing as we're borrowing money like crazy right now. So interest rates will likely go up, I would think, maybe not in the short term, but in the long term. I think that they will follow bankruptcy rates. So as we start to see bankruptcy rates increase and defaults increase, we will likely start seeing interest rates increase. Taxes, as we can see, there's every indication that our taxes are going to go up in a big way as well. And Keith mentioned the bond market. I'm telling you this, the bond market, I can do a whole presentation on the bond market by itself. I don't have enough time, I think, for that. But what I will tell you right now, the bond market is in danger of going into junk status. And what that means is, I'm just going to say it in a really short way, is that the government right now is keeping their interest rates by keeping them low. So the Bank of Canada is keeping their interest rates low by buying bonds, as Keith mentioned in his presentation. Now, these bonds, where do they come from? For the most part, they're coming from corporations that are selling bonds because they're in trouble right now. They're having trouble staying afloat. And so the government's saying, yeah, we'll help you out. We'll buy bonds. You just have to pay us back a small interest rate, whatever that is. Now, the problem is that going to be enough to keep these companies afloat? If you dig deep, like I have in the stock market, and looked at what companies are actually doing with money right now, with borrowed money and with bond money, it's actually very worrying, because what they're doing, instead of paying down debt, which would help them stay afloat, they're doing things like buying back their shares and paying dividends, which is not sustainable, which means many of these companies will go bankrupt. And when they go bankrupt, the bonds that they sold will be worthless, which means the government of Canada will have zero money coming back for all the money that they lent out. That's going to be a big problem. The gurus are looking at this as one of the major factors in the downfall in the upcoming crash. They've been looking at this for years. This is not a new thing. This is not because of the pandemic. This has been happening for years now. And even before the pandemic was happening, we were looking at a massive crash due to the credit market and the bond market. It's anyone's guess which one will tip over first, but when it does, it's going to be a big fall. There's no question about that. And pensions, just a quick note about pensions. Our pensions, our Canada Pension Plan, if you are a teacher or a government worker or anybody who has a pension with your job, your pensions are tied into the bond market, and they're also tied into the stock market, much of it. So if that falls, chances are your pensions are going to also fall and become worthless. So if you know anybody, if you are depending on pensions for your future right now, you need to look at a different avenue, because I tell you, if this falls, you're going to be in trouble. Many of us have parents, baby boomers that are retired who depend on pension for their income. This is a very worrying thing. If you are responsible for your parents right now, or anybody that's on a pension, you need to be looking at that very closely, because that could be a big problem in the coming years. So just in summary, the things that we need to be watching as investors right now, we need to be looking at the unemployment rate, and also the migration rates, inflation, and devaluation of money. We need to be looking at taxation, the debt crisis that is probably going to be coming up due to bankruptcies. We're also going to be looking at the bond market potentially crashing as well, and that'll follow with a pension crisis. We're also going to be looking at foreign investments, potentially doing a big impact as well in real estate and in investments in general. We need to be looking at outside elections, such as the US election and potentially Canadian election. There's been a lot of the gurus I'm following right now are saying that no matter what happens with the US election, no matter which direction, it's going to have a huge impact on all kinds of economic factors. So we need to be watching that closely. And China is one of our biggest suppliers, as we've seen with this pandemic. They control a lot of the things that come into this country. We've seen that with our medical supplies. And so supply chains are broken. We've got a trade war between the US and China and Canada. We've got so much happening on that front. I can't even talk about, I don't have enough time to talk about it, but we need to be watching that. So how does this impact real estate? Well, the things that is going to impact us is, for one, many tenants will be losing their jobs, probably permanently, and they won't be able to pay us back our rent. So we're also going to be seeing that erosion of incomes, which will reduce rents even if demands go up. So if people start walking away from their homes, we're going to see an increase in renters. However, they're not going to have the ability to pay. So even though we have an increased demand, we're still going to possibly see a decrease in rents simply because of the affordability issues. If you are a person who's got joint venture partners, so Keith, you mentioned you've got a whole bunch of joint venture partners, you need to be watching them as well, because are they going to be losing their jobs? Are they going to be able to keep qualifying for mortgages or for the renewals that you need to keep your investments going? Our joint ventures may be going to get into some financial trouble and want to all of a sudden liquidate, come to you and say, I need out, so that's a definite possibility here. So ultimately, cash flow is going to be significantly reduced as rents go down and expenses go up. Lenders may also find themselves in trouble if bankruptcies increase to a much higher level than they're at now. And actually, bankruptcies have already tripled since January. So just to give you an idea of what bankruptcies are already looking like right now, and it's not even the worst of it yet. Financing will be more difficult to obtain and with higher interest rates, and the cost of materials. So if you're a renovator, that's definitely going up as well. So property values will ultimately, in the end, begin to fall. So right now, if you've got properties to sell, it's a good time to do so, as we're still seeing demand enough to keep those property values high. And So we want to now also look at potentially interest rates going up in the future. So if you're looking at renewing some mortgages right now, it might be a smart idea to fix those rates so that you're hedged and you're protected for any future increase that might happen. And utility bills will also go up because our taxes are going to go up. I've already seen all my utility bills, my maintenance fees, my insurance has doubled. All of my bills on my properties have already increased by, by up to 50%, which is already crazy. And I think that's just the beginning. So when it comes to cash flow numbers, your cash flow, whatever was acceptable to you previously, I would triple that because you really need a good buffer right now. So we're going to be seeing an increase in taxes, which is going to squeeze already stressed income and devalue people's life savings as well. And then because most of people's life savings are in their home, and then they're going to be taxed on that as capital gains likely in the future. So what do we do? What do we do as investors? This is all bad news. Well, it's not really bad news if you're a strategic investor because you know what to do. So these are the things you're going to be doing is you're going to hit the pause button right now. Like if you haven't done that already when the pandemic started, do it now. You need to look closely at your portfolio and your finances, and you need to start looking that 5 steps ahead. How is that how are all these factors going to impact your portfolio and your finances into the future? Do what you need to do is remove debt, so including mortgages as much as possible so that you do have a nice buffer for your cash flow, and you've got very low expenses going forward because there's a good chance your incomes are going to increase with the increased taxes as well. So stress test your own finances and those of your family, particularly if you've got some aged parents that are depending on pensions right now. Stress test it. What happens if that pension disappears? Are you going to be able to still look after them? That's the big question there. So you're also going to want to stress test your tenants and your joint venture partners. Do they have a job that's protected? Is it recession proof, depression proof? Joint venture partners, same thing. Do they have a job or income that is maybe unstable, that could potentially be lost in this turmoil that we're going to be experiencing? So choose your tenants and partners extremely carefully right now. I'm telling you, this is going to be a make or break deal for you coming up. So you're wanting to focus on strategies. So the strategies that you want to look at is strategies with little to no financing. So if you do get a mortgage, make sure you have a massive down payment. So Keith was saying that with investment properties, a lot of lenders were looking at about a 30% down. I agree with that. If you can go higher, then that is your best bet. Because you're definitely going to need a buffer in the coming years. You're going to want to focus on very low risk long-term buy and holds. So the acre system is the one you want to follow right now. You need to look at having really good cash flow, and I mean like really good cash flow. Like look at today's expenses and triple them and see if you're still going to be cash flowing. Look at today's rents and decrease them by 10-20%. Are you still going to be cash flowing if that happens? You need to look at worst case scenarios right now with your cash flow numbers. You want to also factor in, if you're doing any renovations or flips, any increase to costs in your renovation projects. Those costs are increasing rapidly right now. So it's one that I would avoid. I would avoid fix and flips entirely right now due to that, because there's a very high chance you're going to be losing money on those. And the other thing you need to be doing right now is diversifying your portfolio. You need to be looking at other streams of income. If real estate's the only one you have, you need to be looking at other ways to increase that. So I have diversified my portfolio into stocks, and I think right now, it's the best thing to do right now is to learn about stocks, because the upcoming market is going to be such that it's going to be raining gold. And I don't know about you, but I'm going to have my bucket out catching those pieces of gold. And you're going to want to do that too, especially if you only have one or two streams of income. You need to diversify that, especially now. So you want to focus on investments that you know about. So if there's something that another stream of income you're looking at and you don't know anything about it, for example, stocks, you need to learn about that. You need to make sure you know what you're doing, because as we know, even in real estate, if you don't know what you're doing, you're going to lose money, right? So you don't want to do that. And in particular, when the media headlines tend to scare us and tend to make the crowd go in a certain direction, we don't want to be those people. In fact, in the words of Warren Buffett, be fearful when others are greedy, and greedy when others are fearful. And above all, right now, we need to be focusing on is don't lose money. Okay, so this is such a cute little cartoon here. Warren Buffett has had so much criticism in recent years. He hasn't been making money because he's been the black sheep running in the other direction, because he sees all the stuff I just mentioned now. He's like, nah, the market's going to fall. When it falls, I'm going to start buying stock. And so the same thing goes with real estate. We're going to see a drop in prices. That's when you're going to be wanting to buy. That right, not right now. You're going to want to sell right now if that's the case. So in summary, we've got the real estate cycle beginning a slump right now. Our real estate market is overheated right now, so it's a good time to shore up your portfolio and make it recession, depression proof. Economic factors to watch are all of these things, which I won't cover again because I've gone over them a few times already. And so in the next 3 years is when we're going to start seeing these massive impacts to our portfolio. So we have a little bit of time to shore ourselves up, but I wouldn't wait. I'd be starting right now, because we never know. We just don't know how quickly that credit market and bond market's going to crash. So don't fall into the greed and fear mentality of the crowd. Do the opposite and you'll be doing fine. All right. And so does anyone have any questions? I know I covered a lot in this 52 minutes here.
Monica, I've got a question for you.
Yeah.
So, and I have not seen this anywhere, any information on what are the chances we're going to see a huge spike in pent-up immigration when we get borders opened up to international countries? I mean, we are seeing planes from international countries still coming in. We haven't seen anything on what immigration from any of that travel looks like. Did you find anything in your research with regards to pent-up immigration?
The only stat I found is that the government of Canada is approving applications, but it's a slow process. So we're still going to be seeing at least minimum 30% decrease in immigration coming in, and it's not because that they aren't approved. It's because the paperwork is slow, and it's also got major border issues right now due to the pandemic. So in the next year or two, I think we're going to be seeing a massive decrease in immigration rates. Even if the government of Canada does rubber stamp people to come in really quickly, I just don't see the border restrictions going anytime soon. So in either case, it's probably going to be slow. And all the stats I've seen have said that, it's definitely going to drop by at least 30%, if not more, in the next year or two. So, yeah. Mm-hmm. All right. Does anyone else have any questions? So David's got some idle cash sitting around from previous property sale. What do I advise to buy? Dividend stocks or wait for property value to correct? So that's a really good question, David. Obviously, that's a personal thing. You need to look at your own personal situation there. I'm not a financial advisor, but I'll tell you what I'm doing, and hopefully that'll help you decide whether that's also good for you. I am actually, I've been a real estate investor for 20 years, and I've hit the pause button on that. I'm not buying any more real estate right now due to a lot of reasons. Number one, I can't get financing, but looking at all these environmental, economic factors, it's not something I'm going into right now. I'm actually saving all of my cash, just like Warren Buffett is, and I'm waiting for it to rain gold in the stock market. That being said, we're going to be seeing a lot of companies go bankrupt. So you need to be really careful which stocks you purchase. Okay. If you buy stocks from a company that goes bankrupt, you lose your money. So it's vitally important you know what you're doing. And I am teaching the 5M strategy, which Warren Buffett actually it's the strategy that he uses, which is equivalent to the acre system in real estate. And this strategy will protect you. It will show you how to find the companies and the stocks that you need to be focusing on, and what prices to buy them at, more importantly. So if you're not really sure how to do that, I highly recommend you take my course. It starts September 14th, and you'll be well positioned at the end of 8 weeks. It is an 8-week course because there's a checklist of things we need to look at, and you really need to understand it. You need to stay in the circle of competence, and at the end of 8 weeks, you're going to be a pro at stock investing. So, so it's a really great one to do. Dividend stocks. In my course, the 5M strategy, so if we look at Warren Buffett's strategy, he doesn't actually focus on dividends per se. He focuses on the quality of companies that he purchases. So dividends by themselves, especially now, don't mean much, especially because there's a lot of companies who are borrowing money at cheap rates to pay their shareholders dividends, even though they're in a really precarious financial situation right now. So if you're only looking at dividends in your stock investing, you could potentially be losing a lot of money if your company is not financially sound. Okay. So what do you think of Section 8 housing will be affected as rental property? So Terry, I'm not familiar. What is Section 8? Did you want to, maybe I'll unmute you and we can have a chat? Are you there? Oh.
Can you hear me?
Yeah, I can hear you. Yeah. So what do you mean by Section 8?
Section 8 is something in the United States for low-income housing, where the government pays a percentage and the person renting from you only has to pay, like, say, $75, and then the government pays the rest of it to make sure that low-income people are able to get housing. I don't know if they have it in Canada, but that's what they do in the United States.
Yeah, in Canada, I think, I guess that would be equivalent to our welfare program. We do have low income housing too. Now, anything government related right now, I'd be a little worried about, because the governments they're taking on so much debt right now, and they're devaluing money right now. It's such a point that I don't know if they're going to be able to sustain the supply that's needed for all the housing for low income people right now. I mean, I'm worried about that. Anything to do with a government program is probably on the chopping block in the near future. It doesn't matter how vital it is, it's probably going to get some kind of cut. So I definitely put that on my radar. If that's something that you're looking at investment wise, if it's impacting that area. If you're a real estate investor that is maybe focusing on low-income housing right now, I think that's probably the best place to be, actually, because we're looking at a massive drop in incomes right now. So if you're able to get low rent housing out there, I think you might actually be a winner in this game in the future. So that's definitely a good place to be. Does that answer your question, Terry, or did I just confuse you?
Thank you.
It does. Okay. All right. Well, thank you so much. All right. So we've got Keith. So we've David. So someone's got a real estate investment property with proven cash flow and economic. So, so yeah. So if you're fortunate enough to find a joint venture partner that is recession depression proof, then yeah, absolutely get out there. Just make sure your cash flow numbers are good, so that you're not finding yourself in hot water in the coming years. So I would definitely do that. So we're at the end of my hour. So does anyone else have any questions, or are you good to get going? So tomorrow we're actually going to start diving deep into some specific strategies that real estate investors and investors in general can use in the coming market, that's going to help them improve their investments, reduce their risks, increase their incomes. And that is definitely an area that you want to be focused on right now. So you definitely want to show up for tomorrow. We've got Sherilyn Milsom from QD HomeQuest. She's going to be talking about picking up properties with an agreement for sales. And that is a strategy that allows you to pick up properties from distressed sellers without actually having to get a mortgage, which is really interesting, because that, as we can see, the lending market could be a bit precarious. So that's a really good strategy. If you don't know about that, you definitely want to come to tomorrow and listen to Sherilyn speak. And then right after that, I'm going to be talking to my good friend Kennedy Gates. He is an immigrant to Canada who has taken Canada by storm. He just sees this country as a really great place to live, work, invest in, and he believes in multiple streams of income. He's taken himself from zero to a really nice place, and he's really heading towards his goals really nicely. He's done that by diversifying his portfolio, which is something that we're going to be talking about tomorrow, because real estate, we love real estate. We all know it's a really great investment, but I think right now we need to be, as investors, looking at all kinds of options right now, because there's a lot of opportunities coming. And as we saw in the Great Depression, there was a lot of people who lost money, and there was a lot of people who made money. And we want to be those investors that make the money. We want to be the ones catching the gold falling from the sky. So we'll be looking at that tomorrow. All right. Well, if there's any more questions? No? Okay. Well, thank you so much for coming. I am so excited that everyone showed up here, and we will see you tomorrow. So these recordings will be available after the event early next week. And they will be available to you for $47. So watch your emails for that. If you have any questions at all, you can absolutely email me at monica@guruintelligencenetwork.com. If you're interested in learning about my stock course, go to www.guruintelligencenetwork.com. I have, because we're doing this live stream, I've got like a super fantastic deal for you. So go visit my website. All right. All right. So thank you so much for coming, and we will see you tomorrow. All right.
Good job, Monica.
Thanks, Keith.
Thank you. We'll see ya.
See you.